everyone. Today is January 20th, 2021. I am Ashley Wilkin, Senior Wealth Manager with the Rice Partnership, and I have Orest Saikevych here, our Chief Investment Officer. Happy New Year, Orest.
Happy New Year to you, Ashley, and to everyone out there.
So we're hoping that 2021 is less eventful than last year, but we're still dealing with some of the repercussions of the pandemic and the stimulus that went along with shutting down the economy. So we have quite a few clients asking lately, is inflation going to be a problem going forward because of all the stimulus and the Fed's target rate of 2%? So what is your outlook for inflation?
Well, Ashley, I feel that inflation will rise this year, perhaps even go a little bit above 2%, which is what the Fed would like it to accelerate to, partly because of the economic recovery we see unfolding with the help of the fiscal stimulus and also the vaccines coming online more. And then also because of anniversarying. In other words, very, very weak economic numbers last year and the inflation numbers last year due to the pandemic being anniversaried, being taken out of the numbers going forward. So it's going to leave comparisons where the inflation is going to shoot up on a year-to-year basis. But the Fed knows this, and they see it as being transitory. So they don't see it as being a longer-term problem.
So they think that the inflation rate is going to be a little bit over 2%, but how do we know it's not going to shoot up in the long term and be a problem in the long term?
Okay, well, overall, one of the things that we're going to be looking at is at the velocity of money. In other words, the speed in which money turns around in the economy. That will have to rise and keep rising on a sustainable basis. So far over the last 2 decades, believe it or not, the velocity of money has been falling in spite of massive stimulus that we had during the great financial crisis. And as a matter of fact, last year when the Fed had their QE program and also the $2 trillion CARES Act, the velocity of money really just ticked up in the September quarter. That's going to have to come up quite a bit for quite a period of time for us to be concerned. Also, we would look at longer-term interest rates like the 10-year Treasury to see if that spikes and keeps going up. We've seen it come up, but not nearly enough for us to be concerned.
Okay, so what are we doing in clients' portfolios to combat the potential risk of increased inflation?
Overall, our asset allocation, we have a moderate tilt towards equities, which we've had for some time now, and we've tilted it slightly more out of fixed income just recently. Also, within the equity portion of the portfolios, we've increased more value stocks or cyclical stocks that do better when interest rates might be in a rising and when inflation may be picking up from a low level. We've also decreased a little bit our growth stocks and defensive stocks that normally do well in a recession, but perhaps might lag a bit when interest rates and inflation picks up a little bit. And finally, we have our alternative strategies. In this case, we have our gold ETF, which should do well if inflation picks up.
Okay, great. Well, we appreciate your insights as always, Orest, and we will see you next month.
Thank you so much, Ashley. Stay well, everyone.